something is happening in the global silver market. There's a fracture forming, a quiet but really significant split that suggests the price you see on your screen might not be the whole story.
And that brings us to the central mystery we're unpacking today. How on earth can a single commodity, silver, have two very different prices at the exact same time? It all just depends on where in the world you're looking.
And look, we're not talking about a tiny difference here. Right now, silver in the US is trading for about $94 an ounce. But over in Shanghai, the price is closer to $104. That's a spread of almost 10 bucks. This isn't just some market hiccup, this is a major signal.
Look, so let's get into it. Most people just watch the markets go up and down. This channel is for people who want to understand why they move. If you want to stay ahead of that curve, go ahead and subscribe. So let's get into it. Let's investigate this $10 mystery and figure out what is really going on behind the scenes.
Now, the key thing you've got to understand is that this price gap isn't just about exchange rates or shipping costs. No, it's a sign that two of the world's biggest markets are being driven by completely different forces. They're telling two completely different stories about what silver is actually worth.
And to crack this case, we have to look at how the West prices its metal versus how the East does. And this brings us right to the heart of the issue, the battle between so-called paper silver and actual physical silver.
This chart, wow, it lays out the two opposing philosophies perfectly. Here in the West, on exchanges like the COMEX, the price is really driven by financial instruments, what we call paper trading. But in the East, on the Shanghai Gold Exchange, the price is way more grounded in real-world supply and demand for the actual physical metal you can hold in your hand.
So what in the world is paper trading? Well, it's basically when traders buy and sell contracts for silver, but the vast majority of those trades are just settled with cash. Money changes hands, but the actual bars of silver, they almost never leave the vault. It means Western prices are often more about speculation and big picture economic trends than about how much metal is actually available right now. Now, China is telling a totally different story. They see silver as a crucial industrial asset, for things like solar panels and all our electronics. Plus, there's a really strong cultural preference there for actually owning physical bullion. This intense demand puts direct, real pressure on the local supply, which naturally pushes up the price for metal you can actually hold.
Okay, but there's another layer to this mystery, a pretty surprising twist involving what are called exchange-traded funds, or ETFs. Now, these are funds that hold physical silver, and what's been happening with them, well, it adds a whole new dimension to the case.
Just wrap your head around this number for a second. In just the first 2 weeks of this year, a staggering 528 tons of silver flowed out of Western ETFs. I mean, that is a massive amount of metal just leaving the system.
Now, normally, when you see investors dumping an asset on that kind of scale, you'd expect the price to just fall off a cliff. But that didn't happen with silver, not at all. So the obvious question is, why not? What gives?
The most compelling theory, the one that makes the most sense, is that this silver isn't just being sold off into a weak market. It's being deliberately withdrawn from the ETS to meet intense physical demand somewhere else in the world, demand that is so strong, it's just soaking up all of that supply without even blinking.
We've kind of seen this movie before. Years ago, the palladium market went through something really similar, where its ETF stockpiles were completely drained dry to feed desperate industrial shortages. It's a powerful historical parallel that really suggests something significant is going on here. So let's connect the dots here. We've got a huge price gap between the East and the West, and we have massive amounts of physical metal just flying out of Western vaults. This all points to a market that is under some serious pressure.
Now you might be wondering, hey, why don't traders just buy cheap silver in New York and sell it for a huge profit in Shanghai? That's called arbitrage, and trust me, it's not that simple. Moving huge amounts of physical silver across borders involves massive logistical hurdles, from just getting your hands on the metal to navigating all the complex regulations. These barriers are exactly why that $10 price gap is able to stick around.
And this quote really gets to the heart of it all. What's happening in the physical market, the high prices in China, the ETF drains, it's like an early warning flare. It's a distress signal regarding supply and demand.
So here's the bottom line. That $10 gap isn't an illusion. It is proof that in the real world, a bar of actual, deliverable silver is currently worth more than the Western paper markets are admitting. The physical market is screaming that things are tight, a message the financial markets just haven't priced in.
Reality.
And that leaves us with one final, pretty provocative question.
This massive gap between the physical world and the paper world, well, it can't last forever. Something has to give. So is the paper market about to get a serious reality check and finally catch up to the price of physical silver? That is the question every investor should be watching very, very closely.
Most investors are going to spend the rest of the year just chasing headlines and reacting to fear. But the real edge, the real alpha, is in understanding the underlying structure of the market before it becomes common knowledge. So if you want to keep your focus on the signals that actually matter, this is where we do that.